VC panel. We have on the panel Sergio Monsal from Northwest Venture Partners, and we have David Saunders from Crossland Capital, and we have Don Butler from Comvest Capital. Thank you all three for joining us here. I'm going to do this a little bit differently than Greg did, because I've got some questions to ask all of them. But before I start, I want each of these gentlemen, since this is the first time I've met them, I'd like them each to introduce themselves rather than have me jumble it up. So Sergio, why don't you start?
Can you guys hear me back there? Yeah, sounds like it.
Oh, yeah.
It's a pleasure to be here. Thanks for the invite from all the folks at Orrick and from you guys as well. I'm a partner at Sergio Monsal. I'm a partner at Northwest Venture Partners. It's a multi-stage, multi-region, multi-sector venture fund based in Palo Alto. We also have lots of offices in New York, here in San Francisco, Israel, China, and India. Offices there. My specific area of focus is what I would say is the intersection of FinTech related investments, so it's obviously straight FinTech as well as we do a lot of security, which is very related. I'd say I'll touch on that, as well as e-commerce and a few other areas within the mainly consumer-facing technologies. Although we do a variety of things, we're a established fund. We have over 50 years under our belt, although I haven't been there that long. And neither have my partners, frankly. We are running out of our 11 fund, and it's a $1.2 billion fund, about $5 billion under management or so right now. So we'll talk more about our investments in FinTech, but the notable ones are Lending Club, we're the Series A there, as well as another one in the brokerage space called Motif Investing, a few others in India as well, and we'll touch on that afterwards.
Thank you, sir. David?
Sure. So I'm feeling really non-cosmopolitan for that introduction. We got one off. So I'm David Silverman, partner at Crossland Capital here in San Francisco, so we don't have an office in New York. We have about $2 billion under management. We invest across all growth sectors of the economy, but primarily technology. We're very software-centric, and we do a lot in financial services and financial technologies. What's different about what we do, maybe not so cosmopolitan, my friend here, is we actually have a split house, so we invest on the venture side, we invest in private companies, but we also have a series of hedge funds, so invest in public markets. And so what we try to do is find challenging, disruptive themes and find the best companies regardless of stage and regardless of whether they're public.
This is working over Tom from Comvest Ventures. I'd say we're a $250 million evergreen fund, a little bit unique from most funds that are out there in the sense that we're investing in one individual assets, like the gentleman that are in the Peter Thompson. My boss is also in the room here, so ask the most embarrassing questions you can find. This would be a great experience. The thing that allows us to do is also specifically for 1/3 of the investment people, which is Series A and Series C capital investments, is that we do both equity investments into companies and then the 3 online lending platforms that we've invested in, which are Lending Club, Cabbage, which is online loans to small business, and the mentioned earlier, Lenda, is that we can also do both equity and we provide loans through those platforms to individuals or small businesses. And so the perspective we have is kind of unique, and you see both sort of how the platforms can develop, but then also how the return profile will work for people who are putting dollars on it.
Okay, thanks. So let's dispense with Bitcoin once and for all today by asking one question about it and then moving on to the alternative lending space and the money management space and a few other interesting areas. We really get a lot of Bitcoin, but I think, Dave, I'm going to ask this one of you. In the payment area, it's obviously everything being overwhelmed right now by Bitcoin use and perspectives. But regardless of whether you're a believer or a naysayer, do you think this controversy is helping or hurting this process? prospects for, let's say, less dramatic and less sort of high-profile alternative payment technologies. Do you think Bitcoin is clouding the air, or do you think it's causing people to pay a little more attention to payment?
I think it's causing people to, I think that's pretty clear. I think it's raising the profile of payments. I think that's good. Maybe one of these things where, all publicity is good publicity. and although we don't have a direct investment in Bitcoin in our current fund, we're carefully watching what's going on here. And I believe that there's some very disruptive things that are going to happen. So I think it's good. And although controversial, I think there's a lot of positive things that are going to happen in terms of true disruption on the payment side. And we also believe strongly that there's an ecosystem around Bitcoin that's actually taking interest in the Bitcoin as much as it's.
And Don and Sergio, anything you would add to that on payments?
Well, I would say that one of the numbers we cited earlier is the awareness that some of these sort of travails of trying to economic actions, played out on the front pages of Wall Street Journal on sort of a continual basis. Bad for the investors who have money in the stocks. I do think it's good for Bitcoin. It's something we all know what it is. And from having worked with companies that have been trying to build a brand, I don't think Lending Club has sort of 50% awareness, even though Lending Club has become a very large business. And so in that sense, I actually think there is a net positive, and people at least know what it is.
I just want to address, I think I agree with you guys, that the examples I go back to, and I think you showed that chart, which actually was very interesting to me, is that I'm trying to go back in time when this happened in other areas to try to sort of do some pattern recognition. I think you guys remember in the 90s when there was the CLEX that they were talking about disrupting all the incumbent LAN networks via IP networks. That didn't work, and they essentially subsumed the IP networks inside the CLEX, the LAN incumbents, right? Verizon and all those. Same with TiVo. TiVo is a better example in that TiVo was supposed to kill TV, right? Tiny little company, but there's so much publicity that eventually all the incumbents subsumed it, and everybody has a DVR now, and it didn't kill TV. I think Bitcoin could end up being nothing, or could it end up being a set of startups that create something. I'm tenderly bullish on it, but at the end of the day, it could be subsumed inside some of the traditional incumbents, and it could just be part of life, right? So I think there's not one or two outcomes, binary. It could be the middle somewhere, like essentially TiVo was, not TiVo itself, but the TVR concept, or the CLEX, right?
I think we can count Sergio and David as bullish. Where do you come out on that index, bullish or bearish about Bitcoin?
Actually, bullish in the long term, but to me, the thing that is surprising is in the past we've done a lot of investments in security. And one of my favorite stories that's sort of security related is that there was an advisor to a guy named Rob Chestnut. Rob Chestnut was a federal prosecutor, worked on the Open James case, he was in D.C., worked on all the mom cases. And this is back in sort of the early 2000s. And he read a thing that opened the post about this little company called eBay. And so he wrote a letter and said, "Hi, my name is Rob Chestnut, I'm federal prosecutor doing this, and I think if you're successful there, you're going to get to know my people." and she actually called him next week, and he became employee 201. And he then became the EVP of Trust and Security. And I kind of feel like Bitcoin's at that moment where, because they've got money and because they apparently have very lack of security, they would be an ideal target. People know there's a support value there. They also probably know, if you're a hacker, you probably know that the infrastructure to protect it, like a weaker than a bank, and there's no property rights associated with it. So therefore, what is the enforcement? So to me, that's sort of a perfect opportunity for the right groups to go after it. But having said all that, I think those will get fixed. And over time, things like vision, that could be good.
Well, Al Capone fell to the IRS, so the IRS is in the game now. Let's see what happens next. Let's move to alternative lending and the democratization of capital access, as it's called, because it's all the rage, obviously. Peer-to-peer networks, I thought it was interesting. Argument from Prosper and Ron Suber, who was on the here today, but he has the flu. I know when I sort of looked under the cover at the peer-to-peer networks, I found out there was a lot less peer-to-peer going on, and the attention was moving away from that. So it was kind of interesting title to get you interested. It would like to come on, whether it was intended to that or not. And it's obviously less of the product now than it was. But in addition to peer-to-peer networks, you got crowdfunding, automated origination, underwriting, lots of stuff going on. You heard about the millennial disruption index telling us that banks are dead. I guess my big question, and you can take this anywhere you guys want in terms of alternative lending, but my question is, do you really think banks as lenders are dead men walking, or do you think that you can possibly, given the size of the global economy, sort of have alternative lending replace banking? So that's obviously intended to be a controversial issue, but take it away. Sergio, why don't you start off?
I would say I'm trying to take myself back to see if when we met Ronaldo Planch lending club about I think it was 2008 or 9, so it's 6 years ago, and he's man in a PowerPoint, and he was telling us about this sort of peer-to-peer thing. I think his vision is coming really true as the founder and CEO of Lending Club, in that it doesn't have to be a peer-to-peer. It just enables the system to be frictionless. It could be an institution to an institution, frankly, or a peer, a person to a person. So I think his vision was just to make sure that the cost of doing business and the friction of doing business was reduced, and I think he's accomplished that. Now, to your question, I don't think necessarily he will win if he gets rid of all banks. The banking sector offers other things, relationships, offers, some people want to do business with somebody face to face. We don't necessarily have that. So I think there's room for everybody to play, and I think he probably feels the same way. It's a big industry. He has a lot of room to grow, and I think they can coexist.
Sure. So we're an early investor in Prosper, so we're big believers in this disintermediation and the opportunity for peer-to-peer lending. I think you asked a couple different questions to try to peel the onion back on you. You're right. A lot of this is institutional lending, not peer lending with peers, but there's nothing wrong with that. Secondly,
Should be an investor.
yeah.
Profits.
Or if you're a borrower, right? Markets work, and this is a business where I think we're in the really early innings of disintermediation. And if you look at all sorts of different sectors of the economy, when you can insert markets over intermediaries, you can really unpack the economics that are in that value chain, and we're seeing that already. So it works well for borrowers, it works great for lenders, it's great for peers, it works great for institutions which are essentially lending on that platform. So our view is this is a completely broken value chain that is in the early stages of being disintermediated, and that's nothing but goodness for everyone. So that's sort of our core thesis, and I don't think banks are going away, which is one of your other questions. I'm sure they're not, but I'm not going into banks and getting posters like we did in the 70s. So I think that the world has fundamentally changed, and I don't think my daughter will have that experience that I did, 35 years ago. So I think there's nothing but goodness to this, and I think we're really, really early in a massive set of products that can get laid onto these marketplaces. So Prosper today is, as I think you'll know, is really consumer focused, and a lot of this is refinancing their credit card debt and those kinds of things. But there's just a tremendous amount for that market to open up, and there's a tremendous number of additional products that expand. So I think there's a lot of legs to the story.
And I guess building on that, I think there's sort of two things that are interesting. If you look, I think the average bank in the U.S., first of all, I think the average consumer is 3.2. And I think the average consumer has something like 5 different products in the bank. When I look at lending, they're sort of doing one thing, which is sort of loan origination. When I look at it, what's interesting is the McKinsey study that came out not too long ago that shows the cost of actually doing origination, underwriting, and customer support for online versus sort of traditional lenders, which means is about 50% less. And so to me, talks for lending are efficiency engines that are just driving costs out of the system by moving it into online systems, including online origination. You layer on top of that, it's not having a retail distribution.
Yeah, exactly.
You layer on top of that, not having reserve requirements. It suddenly looks very efficient. And that's what you're doing. And so for me, I don't see any splicing in it. The banks have things like brand name and low cost of capital that these companies probably couldn't do. They also have a physical footprint of the audience. But I do see a partnership, and in fact, in lending club, we started to see some regional banks in this, like Kentucky or Oklahoma, putting money on the system so that they can originate loans that are outside of their own geography. So to me, the thing that's interesting is you start to see this coming together of community banks and online originators.
I have two challenges to all of this positive energy around alternative lending. The first challenge comes from 40 years in banking, because for 40 years, it's all been about disintermediation. It happened to have been called commercial paper in my day, okay? And when the caca hit the fan in 08, everybody, including General Electric, had a very hard time, accessing the commercial paper market. In fact, they had to rethink all of their financing because, what had been a proven vehicle that had been disintermediated out of, short-term working capital lending for banks was suddenly not there. So, first question to think about is, is this just work in good times and then all of a sudden we have a speed bump and wow, everybody goes rushing back into the bank? And then secondly, this is the thing we keep seeing these, especially the collateralized lending situations, especially against luxury goods and stuff like that. You've seen it all. And I worry about that because I think you may be able to automate origination, maybe you will automate underwriting, and that may be very scalable. But the question is, can you really automate the collection side of that? And when I think about the collection side of that business, which is one of the nastier, tougher businesses out there, I just wonder whether or not these peer-to-peer networks that are going to go into collateralized lending have any clue what they're getting into on the back end of that process, because that's a tough area. So let's just, I'll leave both those out there. You can answer any one of them. Sergio?
Yeah, well, first of all, in the case of lending club, first of all, we are a regulated entity, so lending club is SEC, as filed with the SEC. They're regulated. They operate. They have to operate under SEC rules.
Go on.
I'm just.
Make sure it didn't fall in your direction. The best I can do.
Can you guys hear me still? Yeah. Okay, so we are. I think if you look at Lending Club specifically, I can't speak for the other peer-to-peer networks, but Lending Club operates extremely efficiently. They've taken the best out of new technologies, and they've made sure that they were not encumbered by the rules of the past, the incumbent rules. So they have a nice combination of financial services folks that understand what to look for, but also they don't let dictate barriers to them. So they did one thing, well, a few things right early on that made them very successful. One is to work with the government and to be regulated and to be very responsive to the government. So they came out of the SEC process very quickly and flew after that. And then two, they actually put a lot of emphasis on their underwriting prowess. And that was not an invention that they created. This existed in the past and obviously in traditional banking, but they put a lot of emphasis on it. And so I would argue that they have the best of both worlds. I think if there are bumps in the road, of course there will be, but I don't think people will abandon Lending Club. There's a network effect there. Buyers bring sellers, sellers bring buyers, and that I saw that at eBay and PayPal when I worked there for many years on the other side of being an operator. It's very hard to break that moat. it's a very, very tight knit mode that they've created.
Well, they don't necessarily leave Lending Club, but if Lending Club doesn't have funding, because the lenders aren't as interested in some prices, that's what. Don?
I heard Bruno speaking at the Morgan Stanley Tech Conference the other day, and somebody asked me this very specific question, which was, what happens in bad times? Right now, low interest rate artificially suppressed, so that investors like ourselves, when they look at the rates that we're getting on lending, which might be 70%, net of losses or delinquency, that actually looks pretty good now in a high interest rate or other environment, especially at times of tough. And one of the things that they had done was to do a cohort analysis of their lenders in 2008 and what happened. And basically, what they saw when they looked at credit card was that we got sort of 2 standard deviations away from the normal credit card losses. And so today, those are at 2%. Maybe the losses go to 6%, or maybe they go to 7%, something like that. But when the average payout is something like 9%, that's still not bad, even in what might have been one of the worst stress tests that we would have seen in recent times. And so, to me, that says that there are legs there, and I think the efficiency gains are what get you there. I mean, if they did not have efficiency, if it was, we're going to help you market to new customers or something else, sort of a soft benefit, I'd be more skeptical. I think our confidence comes from the fact that I do see this as sort of playing out of the software eating the world.
I like your answer, all except for the 2 standard deviation, because in the derivative business, we used to eat 2 standard deviations for breakfast. I mean, that was nothing in 98, nothing in 54. I can just think so many times when 2 standard deviations wasn't enough to get us home. But David, let me first toss it to you.
I remember those times. But my view would be, I think it's the wrong question. Because basically what we're saying, I don't want to come across as blindly optimistic. I think that's the wrong answer. What my observations were, this is expanding capital formation by bringing things that have been intermediated historically into markets, and markets just work. So you're right. Was there a market that had a massive blow-up in February of 2009, or the Russian crisis in 98, or the other times you're discussing? Sure. But I can't give a better answer than the markets in terms of what worked. So if I think of those times that you're alluding to, banks were not capital formers. They froze up, actually. So creating more pools of capital and more opportunities for capital formation, I think, is a net positive. There will obviously always be secular and cyclical cycles, but I don't see, but I believe firmly that having new, more efficient pools of capital formation is a net positive.
Okay, I think that's a great set of answers. What about the collateralized lending and the repo game?
I would say from our perspective, that's why we haven't invested in anyone who's doing collateralized lending.
Good. Good perspective. Okay. All right, let me actually open that up to the audience because alternative lending is a big enough topic and we haven't done much on it today. So does anybody in the audience have a direct question of the panel? Yes, in the back.
Hi, this is Langley with Something Confidential Partners. I was wondering if you could comment on valuations and where expectations are from here, especially those who have been priced, fairly high. And
What stage?
Across the board. I mean, it's your day. I don't know what people are doing right now, but I'm thinking sort of getting past the 4 to 6 million range, and I'm wondering, where that leads to your thesis of valuation.
Take it away. Whoever wants to answer.
There's different dynamics in different stages. I think the emergence of the micro VC and the angel class affects the valuations in the Series A for us. In certain sectors, in the growth equity or later stage sectors, there's different dynamics. In general, the market, if you look at what is really happening with the IPO market and the M&A, we probably haven't seen as good a market in terms of exits. And these are legitimately good, solid revenue companies. TBD on some of them, TBD on whether they can turn profitable. That's yet another question. But at least they're generating good revenue with the visibility of operating leverage at the IPO or the M&A. So with some exceptions, right? But I still feel like the exits are getting bigger. The thesis around, you said, the software in the world is happening, so the acceleration and the mega exits are happening, and that's fueling a lot of exuberance on the venture side. The dynamics are different. I worry a lot about careless investing on any stage, and that I see happening a lot. So there may be some overinflation because people want the next WhatsApp and are willing to fund 100 of those on a seat basis. But I think that will happen all the time when there's big exits. So as long as the exits continue and they continue to be big, I think there's going to be more attraction to capital.
High at all stages, and so I'd encourage people to take as much money as they can, but always that cheap. Yeah, exactly. We're selling, but in all seriousness, actually, I do believe that that this is an unbelievable time we're living in terms of valuations across all stages, and so entrepreneurs should be, taking advantage of that. But to be more specific to this particular topic, actually, I think financial technology and financial services on the venture side is underserved. So I was being a little bit flippant when I said valuations are crazy. I think this sector is one that's poorly, it's well served on a private equity basis and it's well served on a strategic basis. It's poorly served from a venture basis because venture folks traditionally have a hard time putting their arms around the compliance issues and the regulatory issues and the complexity that is implicit in financial services and financial technology. So, despite me starting by being a little flip on valuations, I actually think that this industry, from a venture perspective, is poorly served, and there's a tremendous amount of opportunity for people like us who are sitting up here in terms of as investors here. There's just a very finite set of investors who are active and are comfortable participating on a venture basis in this industry, and I think that's opportunity for everybody.
I echo the same comments Philip mentioned. What's sort of interesting and relevant for this audience is one of the things that you could look at is I feel like the exits that have happened and the exits that will come, such as like a Lending Club IPO and the type of valuations that I expected that will draw a lot more capital into this space. And one of the things that is sort of fascinating is if you look at venture as a whole right now, it's probably running somewhere like a $25 billion a year investment in the U.S. market. If you look at venture investing into FinTech as a sector, it's been growing pretty rapidly. And actually, what's interesting is 2010 is about 1.3 billion invested into venture. 2014, in like the first 2.5 months, we have 1.3 billion. So we're at 4x the run rate that we were in 2010. And I think it's reflective of the fact that people begin to say, this actually can be a really interesting industry to disrupt. You actually can create something like Braintree or Stripe or Square. And so for myself, if I were to start a new company, that definitely be this good.
Let's shift gears over to wealth management if we can. I mean, that's an area that's near and dear to my heart, having run 3 or 4 big asset management companies. I guess what I consider asset wealth management to be a very fractured industry, or at least very fracturable because of the relationship nature of it. And big brokers and money managers are yielding ground every day to RIAs, ETFs, and do-it-yourself investing and trading platforms, which are cropping up all over the place. Retirement is becoming the big theme. All right, we've got people, from my generation, moving into the retirement years, and they've only just woken up to the fact that half of their retirement income security takes place between when they retire and when they die. So they've got to be pretty sharp investors during those years. Do you really think that the do-it-yourself investing, as many of these platforms offer, is going to cut it? I mean, this is a time in people's lives when they want a lot of help. And I'm just wondering whether or not the big money, maybe the young money, which is always small money in this game, is interested in doing it yourself, but is the big money going to be willing to play do-it-yourself investing? That's just my opening salvo on wealth management. Take it wherever you want.
I'm happy to talk about that. We're investing in personal capital, so we have a thesis behind exactly what you're articulating, which is there's a disruptive opportunity for more self-directed investing with some guidance. And really it's rooted in a couple things. One, the average person's 401k, I think, is something like $40,000. Something like shockingly, frighteningly small number in terms of their real understanding.
Or is at $25,000 or less.
So, yeah,
It's scary.
but so our perspective is the industry is one in which you actually pierce through all the fees, people are paying north of 2 points every year on their wealth management. So if you look at, if you're at Morgan Stanley or Merrill Lynch or Charles Schwab or wherever, and you look at what you're being charged and what are the underlying fees, it's between 2 and 3 points. So just do the math on that, to your point, over 20 years, and it's an amazing amount of money that's being paid for poor wealth management. So what's the point? The point is, are people great at doing self-selected? No, but are there tools that you could use that would give them the same or better results at far lower cost? Yes. And if you're keeping up with the market and you're paying half of the fees that you would pay in a traditional wealth management regime, you just, that's where I think that's where the juice is.
It's hard to disagree with that math, but I'm forced to point out to you that the difference between defined contribution and defined benefit investing is the difference between 2.5% at the low end and 10% at the high end. In other words, people investing for themselves underperform professional management by massive amounts. Might even overwhelm the excessive fees that you're talking about. All I'm saying is if you pick right and you pick good managers and use indexing, you can make sense of that.
I think your premise is wrong. So, Vanguard, you're wrong. You just run the math. Most people in our industry underperform the S&P, right? So, the math is wrong, and Vanguard is a giant wealth manager because of the premise that rather than trying to pay managers, trying to have low fees is how you grow wealth in a market where all you're trying to do is keep up the indexes.
Oh, I would say I'm a big fan of Vanguard for the exact reason you bring up. So I don't actually think you and I are on different ground on that issue because I don't think anybody can actively manage effectively as an individual because they can't pick winners. There's too many people to choose from. It's too hard to pick winners. But I'm just saying that what I do know is that cocktail party investing for 401k participants is a really shitty outcome. What happens is people end up investing in whatever was hot last year, and they underperform by gross amounts. One of the great arbitrages left in the world. The arbitrage between where people invest and where professional money management invest. All I'm saying is, if you can find a way to solve that problem with your DIY trading platforms, then maybe you've got something to work with.
Let me speak to that, because I think we have a solution there in motif investing. When I invested in Motif, it was about 2 or so years ago. Again, a Series A in FinTech. What they're trying to do is essentially say, okay, I agree retail investor is disadvantaged compared to hedge funds in the mutual funds that spend a lot of time and effort researching the ins and outs of every company. Then we actually have advantages from an access point of view. So understand that, but what the retail investor hasn't had is the ability to have a platform where you could actually invest in a theme that they believe in. So a compilation of stocks that you could actually invest in without them being exchange traded funds, because those do carry a load, and when you compound them over time, that does carry quite a bit of cost. But if you compile a set of stocks, so let's take mobile internet motif, right? You could buy that motif. You will most likely, as a retail investor, think that Google and Apple wants to buy, but they may be last year's great play, not this year's. In reality, you should be buying things that are much more correlated to mobile internet, like Newcastle, the guys that do the little tree towers that look like little trees, but they actually provide you fixed internet, right? Fixed mobile internet. So there are things like that you will never be able to discover as a retail investor because you have a day job. You don't do this for a living. You're in a cocktail party setting. But Motif allows you to uncover that and then essentially bet on the fee. So essentially creating a level playing field. Now, you have to pick the right fee, and then there's another set of things that come up with that. But at least it gives you a tool to have an extra edge beyond just picking stocks.
I must admit, motif is one of the ideas I've seen that I actually do like. I actually think it's different, and it appeals to what people should be thinking about as their mega trends, but it'll be interesting to see how it does over time. Don, did you have anything on this topic?
One other type of company that, well, I guess two thoughts. One, a lot of times for FinTech innovation, a lot of things that we see having a higher likelihood of succeeding are things that are going after transactions or things that are less complex. One of the things that we see in this space is actually, the plethora of choices, a kid, you start wondering about, gee, what's this thing called 529 program? Should I be contributing? How much? How do I direct it? There's a raft of questions that come up. Forget about all the tax issues. And so, to me, this feels like something that there will be a big company, but I feel like it'll take some years of innovation. As we started looking at this space, actually, like personal capital quite a bit. One of the things that we also did was we ran a test where we opened accounts with both wealth funds and veterans to see what those would be like as platforms and how to, put in a turnaround of money at the same time to see how they grew. And it was very interesting because 100% automated, rebalancing, all those things. But what was lacking was kind of a personal touch. There was nobody that could pick up the phone and call. It was like, here's your advisor if you have a question. And so in a way, I found they were engaging for about the first 2 weeks. And after that, I think the user engagement just falls off. And to me, that feels like a problem we need to solve. Is to create something that can do simple automated investing, compare it to other alternatives that show me how much better it's doing, and then have more of a direct relationship. And I think it's something that's what the person was trying to do.
You get another shot at it.
Maybe that.
Problem with you, but I just think it comes down to the fees are too high in the industry, full stop. So I think to go to your root question, it's just a massive area to disrupt because the fees are just way too high and the performance is horrible. How is it that every professional manager is below average? I mean, what kind of industry is that?
You're not going to find me advocating active management.
I just would make a simple question. Do you want to loan the federal government money for 10 years at 2.5 points? Or would you rather own corporate America? I'd rather own corporate America.
Okay, let's shift gears a little bit and ask about this issue of balancing. I think one of you put this in as a question. Balancing social responsibility and profit in some of these areas. And maybe what I'm going to say is balancing the desire for anarchistic disruption versus the profit motive. Are they at odds or are they 100% consistent all the time? In other words, maybe this gets at the point of whether you're disrupting for disruption's sake or whether you're disrupting really because you can make a lot of money doing it. You guys run into that as an issue or?
Well, I'll speak to that from a Norwest perspective. I think we have some tenets that we abide by in terms of investing in companies and founders that have a really high moral compass. And ultimately, we make no money off of those guys. Not off of those guys, with those guys. We share that. I think partnering with folks that are going to act that way is much better down the road. And we believe that that's a synergistic thing. You can't invest in certain categories, for example. So anyway, you know what I mean.
I would just say, we have an investment in a company called Lend-Up. And Lend-Up is going after sort of the payday loan industry, but at rates that are substantially lower, and as money gets repaid, you can credit people back, so that the rates continue to drop down the most of the credit card rates. And to me, that actually is achieving both at the same time. The thing that I actually found quite interesting is a lot of times we like to test products out. And so my colleague and I, when we were looking at this investment, said, let's go to a local payday loan store and let's try taking out a payday loan. Let's see what the experience is like. Let's go to like East Cash Express in Redwood City. And it was a mess. You walk in and, first of all the marketing messages are all on the wall. And bulletproof glass. And the experience itself was not one that I would wish upon anyone. You know, and so when I look at that versus if you have to do it online on a Sunday night at home and have money funded in my account the next day, to me, that's actually achieving both at once. And so that's one of the reasons why I like that.
Good example. Does anybody have any questions on the wealth management side? Yes.
Well, sorry, it's a follow-up to a previous question. Jesus is idea right here. I was wondering what other spaces, other than lending platforms, let's say, do you see your companies interested in FinTech, or that you think may be interesting spaces or subsectors for you coming up?
I can start. So a bunch. Anywhere where there's enormous amount of friction and high fees. So I think of things like cross-border payments. I mean, that's a ridiculous process. It's unbelievable how much profit is in the incumbent value chain that can be disrupted, and there are lots and lots of natural corridors in which you can get some leverage in terms of your marketing efficiency. So, I think that's sort of an obvious area that is underserved. And I think another area which Don was referring to, actually, I kind of in some ways disagree in that underbanked is a phenomenal opportunity in terms of a place where we can put money effectively to work. And where I disagree is actually if you were there in line for your payday loan and you talk to the other customers, they like their experience. So it's totally non-intuitive. They're paying phenomenally high APR rates, but if you actually talk to them, it's actually that there must be a tremendous amount of money to be made by having a better experience with serving those underbanked people who are today on the payday because they like it and it's a horrible experience.
This also kind of gets at education because the irony is, as you look at studies, that's exactly what you're saying. The average customer at those places like it. They probably have a relationship with somebody behind the glass, but they're paying oftentimes 600% APR. And it might sound like, gee, I'm only buying, I'm going to borrow $100 to pay back to you at the end of the month for $120. So it's only a $20 fee, and maybe that's convenient for emergency housing or emergency medical, but it's still a ridiculous APR. That's something that I think people, there's this threshold that you cross where you sort of move from things that are in terms of percentage APR to what's it actually cost me. So it's cost $5, $10, and they don't sort of do the math, and that's where I think there is this tremendous opportunity.
Okay, so we have to wrap up, but I want to just do one last test. Which of these guys do you think hates high gouging fees the most? Thank you very much.